Welcome everybody to our 40th episode of our Bay Area Housing Market Town Hall webinar. Let's talk about how do we compete with cash buyers, because as I mentioned earlier, you see like sellers are accepting cash buyers still. They prefer accepting cash offers over finance offers. We still see some sellers very worried about financed offers, even though I do think that a lot of banks are stabilizing. They're not as worried anymore. Our clients are doing pretty well with their financed offers, but still, and from the seller's point of view, they seem to still prefer cash offers. Now, I know a lot of people who cannot offer cash offers. There are some other alternative, slightly more expensive, but it can work just as efficiently and as quickly as cash. So this is where Brad comes in and explain to us.
Again, my name is Brad Laddusaw with S&L Capital Group. We're an asset-based lending company based out of Southern California. My business partner is located in Brea. I'm in Oceanside, and what we specialize in are writing investment purpose loans to real estate investors acquiring 1 to 4 unit properties, multifamily, and industrial warehouse throughout the state of California. Helen, your presentation earlier on the market update, I thought was very interesting how that one seller was offering seller financing on a speed up probably investment property, and that's actually a strategy we could touch on later on what some of our clients have been utilizing out there in the marketplace. That is a creative financing structure you can do, pair it up with a private money bridge loan on the front end to where you as the investor are coming in with effectively zero cash to close, and all you need to do is self-finance the rehab. So that's we're seeing seller financing being more acceptable out there, depending on how much equity is in the property. So we'll jump right into it. And at any point in time you have a question, please just send the question to Helen. She'll just stop my rambling and we could just dive into the weeds on any particular point of this presentation, but I'll try and move it along smoothly to leave time for questions at the end. So hard money, private money, asset-based loans, bridge loans, what's the difference? I feel all these terms get loosely thrown out there in the marketplace. Me personally, I don't think there's much of a difference. It just really depends on what room you're in. You talk to a real estate agent or broker that specializes in the 1 to 4 space and you tell them that you're an asset-based lender or a private lender, the first reply I get is, oh, so you do hard money. You go to a commercial networking event, we're talking to commercial brokers, multifamily, industrial, call it $2 million and above loan amounts, and you tell them that you're an asset-based bridge lender, and then they say, oh, you're hard money. Yeah, I guess that's a mean way to say it. It's a mean term, but yeah, we do hard money. And they say, oh, I've never had to use hard money. I'm like, well, do you have a bridge lender that could close in 14 days? And they say, yeah, I got one of those. I was like, that's hard money. I mean, you're not closing in 14 days unless you're using some sort of private capital on that. And you could drill down the meaning or definition of what term investors or lenders like to use, dependent on the capital source as well. So Helen, I'll send it to you. I wrote an article back in March of 2020 on what happened in the hard money lending industry over the last 2 years that led up to the great pause that everyone I'm sure saw in the private lending industry during COVID. And that was mainly driven by the flood of institutional or Wall Street money that hit the marketplace. They don't like to brand them. In the beginning, they told themselves we're hard money lenders, but then they realized that their capital providers didn't like that term. So they were rebranded as alternative lenders, asset-based lenders, bridge lenders. Again, all one and the same. But if you're talking to an institutional lender, they would probably not define themselves as a hard money lender. If you are getting a private loan from Uncle Joe or Aunt Jane, actually, let me backpedal. Full disclosure, this is not investment advice to any of you. I am not recommending how you should structure real estate deals. I'm going to share what types of structures we have seen out there in the marketplace. So I just want to throw that out there.
And if I may add, is that I had used one or like one of these hard money, or you can call private money or asset-based lending to purchase property just like cash. It's not my cash, it's somebody else's cash. but I could close in 14 days or less as well, as long as the numbers work. And then even there are a lot of companies out there now saying, we can finance you first so that you can buy something else. And then when you sell your property, you can pay them back. That's kind of part of this private money that a lot of other banks that are using or providing. It's just that we call it differently, different names.
Yeah, yeah, we'll jump into why someone would use private money, if it's only for investment properties, or are there consumer bridge private money options out there? Answer is yes to that. But in short, I'd always recommend that if you're going to be using some sort of private money, I'd recommend you go through a licensed company to do so. It's You may pay a little bit more, let's say for origination fees, but after looking at your presentation, Helen, looking at Wells or some of these other banks charging 1% origination or discount points, we got to increase our pricing. I mean, you're going 1 point for a bank loan. It's we're right there with them. But anyways, you have traditional trust deed models or fund models, which are backed by accredited investors, and then you have other institutional models that were backed by Wall Street money. A lot of them have hit pause, stopped lending, or changed pricing drastically over the 6 to 9 months. Not to get into the weeds too much, but they would fund loans on a credit facility, package them up, and then sell them to an end buyer. That end buyer on the secondary market, we're buying these in the forms of bonds, and they stopped buying. So that created a lot of turmoil. So your traditional asset-based lending companies have been busier than ever the last 12 months. Now, why would someone use private money loan? We tend to joke around, no one needs a private money loan until they need a private money loan. The main reason is time. Helen had alluded to this. How do you write those strong offers to close quickly? You'd be surprised how many all cash offers eventually do get switched to financing once they're in escrow and title. It's really just an addendum that switches it from all cash to financing. That's where the experience of your lender that you're working with comes into play, and they need to know how to communicate that change to escrow. My favorite line is, surprise, Helen, you get to work with me again. I'm actually going to be the lender on this one, and they just want to see that you have control over the process. But using a private money loan is really the best way to replicate that all cash offer. You could close with no appraisal options. I mean, we market sub 14 days. We've closed in as little as 3 business days before. We do not market that. I hated that. It was a very horrible situation on our end to, part the seas to make that happen, but we did. And you can't do that with any other type of financing out there. Closing on distressed assets can be very difficult with that regional bank, or if they're still lending now, or your, let's say, conventional lender. And Helen, were you going to chime in and say something?
Yeah, I just want to clarify from our realtor point of view. When we write the offer for you, we cannot, if you're doing a private money loan, we cannot write down all cash offer. Although back in, 10 years ago, back in 28 to 2013, we would write down, hey, this is an all cash offer, because it works just like a cash offers, right? It's like really quick funding, and there's no underwriting on your personal income, and it's asset based. But so regulations in the DRU saying that no, if this is a Hartman lender, you still have to consider this a finance deal. But you can just write in as, at least it's still very strong, very quick closing, and this is like you don't need to underwrite your own income, so it's asset based. So before you make an offer, a lot of times Hartman lender can already tell you whether they will loan you the money or not.
And that's a great point. We like to review a deal very early in the process, especially with our high volume borrowers. They'll shoot my business partner, Corey, an email with the property address, estimated scope of work, estimated closing timeline, and their estimated ARV. And he'll jump in the weeds, do preliminary value check, and say, here's ballpark of where we'll be. Like, let's rock and roll, because we like to pre-approve our borrowers in that fashion. We've been seeing offers written now, all cash, or they'll write in hard money. And to realtors, all fairness to agents and realtors out there, you may not even know that your client's going to use hard money. So you'll see an all cash offer written, and then you're just as surprised as escrow and title. And it's I see how that could put you in a tough spot. But again, that comes into what lender are you working with? Do they have the experience? We've been fortunate to enough volume in our target markets that chances are we've worked with that escrow officer or that title rep before. So it's a very smooth conversation. With our pre-approvals that we send out to our clients with our clients as well to write those offers, we make sure our contact information is on those pre-approval letters so that listing agent can call us and talk to us and say, have you worked with Helen before? What's going on with this deal? Is this loan really there? And we could update them and share how they could vet us as a lender, our processes, and kind of calm the situation a little bit and help. At the end of the day, we just want to help our borrowers close more deals, which helps agents and brokers we work with close more deals as well. Stereotypes out there, I won't go through them or dive into the weeds on them, but hard money stereotypes. We want to take the property. We charge high points, high interest. We're not flexible, and it couldn't be farther from the truth. Very competitive on our pricing. If our borrowers succeed, we succeed. We don't want to do one deal with them. We want to do 20. So it's more so on understanding the situation that's going on, and let's just try and wash, rinse, and repeat is what we like to do. So here's some questions that we recommend our clients ask your lenders. We'd be very naive to think that our borrowers only work with us. I mean, I think I got a great smile and I'm nice to talk to, but that only goes so far. So we've recommended our clients talk to as many lenders out there that you can, and ask process-based questions. Personally, I think asking about pricing on your opening question is completely irrelevant, because if they can't meet your 14-day closing timeline, pricing doesn't matter. So some questions that you could ask to make sure that they're going to meet that closing timeline. Are you a direct lender or are you a broker? Brokers bring great value to transactions, but they're not making that credit decision. We rely on brokers to send us deals to fund on their client's behalf, but they may not be aware of what that actual closing timeline is. So that's a very fair question to ask. And I think brokers bring great value to every transaction, and they could try and get the best pricing for you as a borrower. Do you balance sheet your loans? What this means is, does that investor hold those loans to maturity, or do they sell them off on the secondary market? If they sell them off on the secondary market, they're reliant on that end buyer to always be there. So COVID, a lot of these end buyers hit pause. So a lot of deals at the funding table fell through. We saw this pause and shakeup happen again last year, and then it happened throughout the course of the year as interest rates were running up. So that's a very fair question to ask. And balance sheet lenders, again, hold their loans to maturity, so that end risk is not quite as prevalent. AMC, do you require an AMC for your appraisal, an appraisal management company? So a lot of the institutional money that flooded the marketplace, they required, same with conventional lenders, that you order that appraisal through an AMC. During 2019, 2020, 2021, 2020, they were busy. So sometimes, depending on the market, it could take up to 14 days to get your appraisal back, and you just hope that there's no revisions that need to be made. We don't require an AMC. So we could use appraisers in a target market that we've worked with before, that we have vetted, so we could get those appraisals turned around quickly. Since we're mainly concerned about the asset, that appraisal is more of a check the box, because we are selling a security to our investors, so we do need an independent valuation, or we put one together. Go ahead, Helen.
Question about the appraisal. Will the appraisal based on after repaired value you mentioned earlier, ARV, or is it the current value of the property?
So we'll get both. We'll get as is and ARV combined in one appraisal. One, we don't want, let's say you're paying $1 million for the property. We don't want that property to be worth 800 grand. I think that was a little bit more common a little over a year ago during the buying craze that you were alluding to versus now. We just want to make sure that the as is value is relatively around purchase price. Ideally, you're getting it below market. And then we're also looking at the after repaired value. But as a lender, the way we do things, we've already kind of pre-checked value. So we're confident it's going to come in within a margin of error of what we're seeing on the front end. And again, that serves as an additional inspection for us, additional property information, walkthrough, and checks and balances on value. Another big question to ask, Do you allow for junior financing? A lot of lenders out there, or institutional backed and some others, don't allow for junior financing. The line that they would say is, we allow for it, but just you can't be on the closing statement. What that tells me is their loan docs are probably very clear saying we don't allow for junior financing.
Can you clarify what's junior financing in case like some people don't understand what that means?
All right, so say you're going to pay $1 million for a property, and my company is going to write a loan for $600,000. We will allow you to have another loan behind us in junior position to bridge the gap to your purchase price. So say we're at 600, you have someone bring in an additional 300 as a junior loan. Now you as the buyer only need to come in with that difference of $100,000. So it's a first position loan, second position loan. In the conventional side, you'll see HELOCs at times that are in junior position, and a few other loan products out there. Prepayment penalties. Do I have to pay a minimum amount of interest on your loan? That's a very important question, because if you're doing a value add or a fix and flip and you're going to sell it in 3 months, you don't want to be on the hook for 6 months. Or if you're buying a multifamily property and you think your perm financing is going to be in place within 6 months, you don't want to be on the hook for 9 months of guaranteed interest. So that's an important question to have. Minimum credit score. And me, I like to ask, who's making the final credit decision? Am I talking to a loan originator to then get passed to an account manager, then to have the deal go to underwriting, then to have it go to loan committee, to 14 days later, I find out I don't have a deal? I think it's very important to know that either that person you're talking to is going to be making that credit decision, or they're sitting right next to them or very close, because you just want to be able to get those questions answered quickly. Where can I go to verify my...
Alicia actually want to ask if you do second lien.
We do not. We don't market it. At times we have done them for repeat clients, so there's plenty of room, but we're strictly in that first position lien holder. But we have great relationships with other lenders that we could facilitate a second position loan if it is for an investment purpose. I actually played golf with a lender in Southern California last week, similar structure company to mine, but he likes to do seconds. So we're working on one right now. I'm just trying to keep costs down, but close more deals.
So when you guys play golf, do you always go first, he goes second, just because of the fact that you do first loan and he does the second loan?
It depends on who's buying the beers. It depends on who's buying the beers.
Good.
But
and Dennis wanted to ask if there's a minimum FICO score.
It depends on the company. So you want to ask them, do you have a minimum FICO score? And actually, I challenge anyone that's on this call or listening at a later point in time, go to any Facebook real estate group and ask, does anyone have any recommendations for a hard money lender? Don't share any deals or details on the deal. You will be flooded with recommendations. They'll be throwing out high leverage, cheap pricing, things across the board, but they don't have any information on the deal itself. Credit score for a lot of these lenders is very important. Track record, overall scope of work. These will dictate the pricing and leverage that you're actually able to get. Some lenders out there only want to work with borrowers that have done at least 3 flips or have 3 deals under their belt. Others are okay working with new investors, but these are important questions to ask. Us personally, no minimum credit score requirement. We just don't want to make sure that you're wanted by half of the United States, going through a BK and have some issues that could supersede our loan. We've seen low credit scores mainly due to there being a lot of credit under that guarantor or borrower's name. All the loans could be in good standing, but they could just have 4 different conventional loans. So their debt to income ratios look a little bit skewed on what's showing, and that could lead to a lower credit score, but I don't think it's a poor credit borrower. So I think credit scores can be misleading.
I mean, I worked with you before many years ago, and I remember looking at some deals that you sent me, and I was like, well, their FICO score is pretty low, but you had worked with that investors or the borrower over and over again, and that's why me as an investor, I was like, okay, I think we can work with this borrower and lend him money because he already has an established relationship with you guys and also established experience that they had bought and sold properties before.
Yeah, and it's also as an investor looking to go into deals, I'm more concerned about skin in the game. When I say skin in the game, how much of their own money is in the deal? I would much rather do a 60% loan to purchase price or 65% loan to purchase price loan to someone with a mid credit score in the 550s versus a 90% of the purchase price, 100% of the rehab to someone with a credit score in the 800s.
True. That's true.
It's anyway, so real quick, I won't go into this, where you can vet your lender. In the state of California, your asset-based lending company will either carry a CFL license or they'll do loans under a DRE broker's license. You could go straight to these links here, type in their company name, verify their license. The beauty about California, business owners in California hated all the restrictions in California, but it's to the consumer's protection, and just about everything is publicly available to you as the consumer in this state. So if you go to any one of these links, we do everything under a broker's license. So if you went there, typed in S&L Capital Group, you would see the broker associate, all the employees that are there or license holders. And then what will happen if we were ever audited or something happened where we got dinged for something, the DRE, they actually attach it to your profile. Same with the CFL. So if that lender got run through the ringer for doing some bad acts in the past and they got caught, it'll show there. And I think that's great.
That's a really good point, is that there are a lot of private money lender on top of private, meaning individual, that may not be an actual licensed lender. You just have to be really careful and vet them. References is important, and then check their license. That's absolutely important.
Yeah, and I like to ask questions I already know the answers to.
Mm-hmm.
One of them is, how do you do your loans? What licenses do you do it under? If they can't answer that, or they give you one, it's like, I'm gonna go check it real quick. I think that's very important, because yeah, they may give you a loan, but how flexible are they going to be? What if something happens and legal gets involved? Let's not go down that rabbit hole, but I would much rather be going through a licensed party versus 100% private. For us, what do we need for an initial submission to get something submitted to underwriting? Again, heavily asset-based, all listed here. I won't run through it. And really with us, once you're pre-approved and set up with us on the front end, rolling that loan application with our loan origination software is very seamless on that. And we're just getting updated information at that point in time. Again, we're mainly concerned about the asset. What is your strategy? And what's our exit? Do you plan to sell it? Do you plan to hold it as an investment property? So are you going to need to get a refinance to take us out? Those are all questions we have on the front end. But again, we just want the strategy to make sense. Loan structure tips, kind of alluded to this on some questions to ask your lender. These are some additional questions you could ask. Again, clarifying. Ask them to explain their process. How do I get from initial pre-qual to submission to underwriting approval to docs? Once docs are out, how does that look? And then who's servicing my loan after the fact? These are all questions that you could ask them to help explain the process throughout. But this goes back into kind of loan structures, purchase price, and rehab loans. So a new thing that popped up over the past few years. Well, they'll finance a portion of the purchase and a portion of the renovation. With that renovation fund, a lot of times there's a fund control set up for that, and it's released based on a percentage of completion. So, Helen, if you're getting a rehab loan from us and we finance at 80% of the purchase price and 100% of the rehab, you would give us a call or shoot us a message, 30 days in. Hey, Brad, I'm about 40% complete from the rehab. I am flying. Things are going great. Can you release 40%? Helen, that is great news. It's moving. We're going to need to send an inspector out there real quick. They're going to go out there with the rehab bid, take pictures, and verify that all the work has been completed. And then once the report's back and verified, then we will release that 40% on that. What is an ARV? After repaired value. So you buy your property today, it's worth what it is today, as is value. You're going to put $200,000 into the property to get some future value. That future value is that after repaired value. Loan to cost, if you ask me, it's just a marketing thing. Some guys say we'll do 85% loan to cost. What that means is we're going to do 85% of that total cost. So purchase price plus rehab. Or they'll say I'm going to do 80% of the rehab, 100% of the renovation, not to exceed 85% loan to cost. Me as an asset-based lender, I think less is more. If you need an if-then statement or a spreadsheet to calculate your cash to close, chances are your loan program may not be around for very long. And we have seen some of these creative structures kind of go away over the last 6 months. And here are just a few other questions that you could ask as well. An important one, are you talking to the actual lender? It's great to work with brokers, it's important, but you also want to know that you are direct to the actual lender. And again, we touched on these: highest leverage, experience, extension, all these kind of go into play that you could ask. Pricing, can you expect? Call around. Pricing has gone up. I mean, deals that we were doing at 7.99, 8.49, a little over 12 months ago are now closer to 9.49, 10.5%. So they have gone up. Your traditional asset-based lender companies, similar to structured like my firm, we're typically the last ones to lower rates, and then we're also the last ones to raise them on that side of things. Origination, I don't think you should pay over 2 points origination on any first position deal in California. If you're paying over 2 points, there's a broker involved, and that's okay. But that goes back to asking whoever's doing the loan for you, are you a broker, and how much am I paying you to get me the best deal? It's brokers bust their tails to get you the best pricing, and I think what they charge, worth their weight in gold if the loan structure and closing timeline is what you want. So we've seen deals total pricing be over 2 points if there's a broker involved, but if you're a direct lender, you're direct to a lender, you'll probably be below 2 points on origination. Pay less by knowing more. Not my line, my business partners. The more questions you could ask to vet them and understand their processes, but also what is out in the marketplace, will help you get better pricing. We firmly believe highest leverage is not always the best leverage. And I think we're seeing that now, especially in commercial that you're alluding to. We're going to probably see more commercial defaults than SFR residential going forward, because that value aspect of financing that was provided to these investors or sponsors that were probably syndicating the deal anyways and have very little skin in the game, they don't have a refinance option. So it's going to be interesting to see, and they had really high leverage. A couple quick case studies we'll fly through, open it up to questions on how you could use hard money, asset-based lending, bridge lenders, alternative lenders, depending on whatever you want to call it on a Tuesday. This is a 8-unit that we looked at in Oxnard last year. Very sophisticated investor. He's been buying properties in the Oxnard area since like the early 90s. His preferred lender, he works with Chase. Very sophisticated borrower, but he was under contract to close 12 units in Ojai. A little too rural for us, and it was going to be too tight to meet that closing window to put it together. So what we did is we did a cash out refinance on an 8-unit he owned free and clear, and allowed him to put and went escrow to escrow for him to close the purchase of 12 units. From submission to underwriting and funding, it was 14 calendar days. So a lot less business days on that.
That's including his refinancing and then fund this purchase.
We didn't fund the purchase. He had cash for the purchase. He needed, what did he need? About 1.3, a little less than that net for his closing funds on the purchase. He wanted to keep leverage low to where his perm lender would have flexibility with that refinance on the takeout. So we did a $1.32 million cash out loan for him. I think our interest rate was at 8.5% or so, interest only. I think we only charged a point, but what was important to him was no prepayment penalty. He had his lender in line, and he said, I'm going to pay you off in 3 months. Me personally, I've been told, I'm just damn near every deal, they say, I'm going to pay you off in 3 months. And I say, great. A lot of times it takes 6, 9, 10 months. That's why we're not too concerned with the prepayment penalty, but he stuck to his word, and I think he paid us off in less than 3 months.
I think
But
that's a very good point to make for everybody to understand that this hard money lending or private lending is not meant to be permanent loan. It's a kind of what we call a bridge. Also, a bridge could be a very short period of a few months, where until you stabilize or until you can get a permanent financing. The idea of this hard money lending or private lending is for you to get the deal first, because that's the hardest part is the competitiveness and the very high demand market.
yeah, and surety of closing. If you're more confident in your lender being behind you with X amount of funds, that confidence is going to come through to your agent or realtor you're working with, to where they're going to go and write a very strong offer and say, hey, we're ready to go. Here's the team we have in place. And that's where we've worked with quite a few agents and brokers over the years. And we've actually seen them start taking down more deals themselves as they've kind of transitioned into investors themselves. But in this instance, his important thing that he wanted was no prepay. He's going to pay us off. Every other quote he had, and again, this one came through a broker, so that was representing him on the buy. So this is referred over through a broker. And everyone else was quoting them anywhere from 6 to 9 months of an interest guarantee, or a prepayment penalty, or a yield maintenance, all kind of one and the same. The no prepay won us the deal, and it was a great transaction for us. Next case study, I am trying to keep it to commercial ones. This is a cash out refinance we did last year. This was secured against a trucking facility / office. I know I told you we only do multifamily and industrial. That's what we market for, but we're mainly concerned about the asset. Our borrower had acquired this property in Chino, sitting on 5 acres as raw land, I think back in 2015 or 16. They self-financed the development of this office space as well as this trucking facility. So their basis in the property was over $7.5 million. They were looking to acquire a 3-unit investment property in North Tustin, and they wanted proceeds for that acquisition. So we actually paired this cash out refinance with an acquisition bridge loan on the new investment property to get them 100% of the purchase price. That combined LTV of 100%, we were sub 50% loan to value on this one and sub 65% loan to value on the other property, which allowed us as an asset-based lender, like, we're comfortable from an equity exposure while getting our client the target cash to close and loan amount. So when you want to get creative with structures as an investor or an agent, there's more than one way to use private money if you're using it correctly. And again, this is one, they said they're not going to pay us off for about 9 months. So they were okay with a 6-month interest guarantee. We knew they would be okay with that. So it was like a little win for our investors as well. So you're not going to be paid for a loan amount this size. You're not going to be paid off in 3 months. It's going to take them at least 7 months to get their perm loan in place. So it's kind of a win-win on both sides of the spectrum there. And it's 2.5. So here's the acquisition bridge loan. We put 3.41, and this is the property that they did in North Tustin.
Oh, this is a single family house?
There's actually 3 units on here. So
Wow.
they're acquiring it as an investment property. Their schedule of real estate, I think, stretch across 12, 13 SFRs, trucking facility from Huntington Beach all the way to Orange County. So they've been acquiring real estate pretty heavily over the past 4 years.
Got it. And Alicia, want to ask, like, what about people who have mortgage late due to misunderstanding the loan forbearance? Of course, who have mortgage late due to the misunderstanding the loan forbearance?
So if I understand the question, if we're looking at a credit report and they thought they were getting a forbearance and they're not, and they got hit with late, is that the question?
I believe that's the question. Alicia, feel free to clarify.
So I'll bring this back to a misunderstanding that we were seeing during COVID, where it was on the news. Everyone was saying, you talk to your bank, you automatically get a forbearance. It's not going to affect your credit score. That's correct, but it can affect your lender's decision making on a future loan that you may get, because even though it's not dinging your credit, if they were in forbearance and requesting a private money loan, even for an investment property, and then we saw that they were in forbearance, the question we asked, why are you in forbearance? I'm looking at your bank statements. You got like 1.5 million cash sitting in the bank. Like, they're like, oh, our lender said it was okay. Like, we could do it. So we did. And I think there was a miscommunication there. We saw others that got thrown into forbearance and they did not request it. That was another thing that had popped up during COVID. And then we saw some where you get to the end of that period and what does that look like? And some got hit with late. So we didn't see any, but that's always the risk. And it was there for a reason. There's peak panic and big unknowns during that time frame. But the conversations we were having with our borrowers at that point in time was, do you really need the forbearance, or are you just doing this because your friend said you could get it? And I think there was needed to be a better understanding there. We're very fortunate on our portfolio. We didn't have any forbearance requests. Our investors actually wanted to buy more properties, and based on our performance, our investors that are providing us the capital wanted to get more money out. So we were positioned uniquely in the marketplace at that point in time.
So basically, for you guys, will actually look at the loan, and if there is a forbearance on their credit, you actually want to know why first to understand what is the background of that before you make a decision. So it's not a hard yes and it's not a hard no either.
No, we had one borrower, we had 6 performing loans on the books, and their primary is in forbearance. We're like, why are you guys in forbearance?
So yeah, so this is very much a relationship based as well. We call it asset based. Of course, you do need to know about the property, but it's also relationship based. It's not just looking at the credit score, the credit report. You know, like the more you do business with the Hartman lender, the more they trust that, okay, you know, this is just your sometimes just a business decision. I have done my own deals before with Hartman lending because, you know what, I just need to get in first and then I'll refinance and then I'll do it again and again. So everyone has different scenario why they need to do it. We have clients also need to do 1031 exchange, and they are meeting the deadline and their lender could not finance it. So oh my gosh, it was like within 5 days or less than a week, we had to find a Hartman lender and close it just on the deadline, the last day, 45th day of the day. I'm sorry, the 60th day. 6 months deadline, 6 months deadline, and then finally close it so that our client could do a 1031 exchange without paying for that capital gain tax.
That's a very serious situation that comes up, and we love those situations as an asset-based lender because on our multifamily or commercial properties, we could close with no appraisal. A lot of times with a 1031 exchange, they're coming in anywhere from 40 to 50% down, rolling that equity or those proceeds in to where, hey, let's go. Let's go as quickly as we can on this, and being able to close with that no prepay. And now your perm lender that needs more time to close that acquisition, they could breathe a little bit and start working a refinance. One thing I did wanted to bring up, Helen, that you had asked are consumer bridge loans that are available to home buyers out there. I'm not going to price those out. I could share with you guys a company based up in Northern California that specializes in this, but they have a very creative product where they will effectively cross your current home that you have with the new home that you're going to buy to give you that cash to close, allow you to close. And then once you sell the house you're currently living in, then you could pay off the loan in whole. That takes the whole contingent offer not being accepted off the table. So they have some creative structures there. There are also other just straight consumer acquisition bridge loans are typically less than 12 months. But there are options out there. If you guys want any introductions, I could connect you with anyone in my network that does it. We don't charge for it. We can't charge for it. We don't carry an NMLS, but we could connect you with some vetted lenders in our network.
Yeah, and I hope that we did, kind of give you guys options here. One other thing I wanted to mention, which you kind of mentioned already, is that a lot of times these Hartman loan, like we said, it's a temporary financing option. It is expensive, but it's also interest only payments. So it's not a fully amortized payments. It's interest only, so make it a little bit more more affordable in terms of the monthly payments until you figure out the permanent financing, and that's when you do a fully amortized payments with your permanent lender. I absolutely love this. I loved it so much because I do believe that Hartman Lending was my way of getting into real estate investments more than how many years ago now? 16 years ago. And that was my first deal. I used Hartman Lending, and that's how I started real estate investments. And I've seen how it worked for my clients as well, and help them get into properties that they want until they stabilize the property. They can do a permanent financing, and then they basically gain equity by able to get the deal first. I close escrow really quickly. And I loved it so much that I actually went to the other side to be the investor. That's another way of, if you have some money that you don't want to buy a property, but you want to earn some high interest, you can become the investors for a Hartman lender like Brad, which was what I did back then. And loved it, absolutely loved it. You get the high interest payment every month, and they mail you the check. Well, maybe nowadays you deposit it, but it's a really great way to invest your money as well.
Yeah. Well, Helen, thank you for, if there's any other questions, I could jump into them, but you have anything else for me?
No, I think I thought this was very interesting. I hope that this helped everyone. If you feel like you're struggling to make offers and you want to have a stronger offer, this is the way you can try to explore, as long as the number makes sense. Work with your realtor to run the numbers, and then talk to a Hartman lender. And I hope that everyone will have a happy house hunting. And also, thank you so much, Brad, for joining us. And then next month, we're going to be talking about insurance for commercial real estate. I want to remind everybody to go to our YouTube channel and subscribe so that you can get notification right away as soon as we post these new videos out.